Hello everyone, welcome back to another episode. In my previous episode, I mentioned that I would be selling part of my positions in two companies and I would be adding two companies that are brand new to the portfolio. And the two that I'm selling is IBM and AT&T, and I'm adding WP Carey and I'm also adding Store Capital. And I'm also replacing Store Capital with MAA, Mid-America Apartment Communities. So if you see here in my activity feed, we did morning trading yesterday. And we got rid of nearly all of IBM. We got rid of about 3/4 of it. We lowered our target percentage down from 4% down to 1%. We eliminated MAA. We took about a 35% gain in Mid-America Apartment Communities. And then we also sold half of our position in AT&T. We sold about $20 worth. So the reason why I'm doing this, first I wanted to go over why I'm selling IBM, AT&T, and replacing MAA, and I'm replacing it with WP Carey, and while I'm also adding Store Capital. So I'll be going over that, and then of course we always bought my same usual companies. We use the pie feature that M1 Finance uses just to add a little bit more to all my undervalued companies. So great picks there, and let's go ahead and jump right into why I am selling part of my position in IBM and AT&T. So first of all, those of you that watch my videos know that when I sell or I buy positions, it's not based off of the stock price. If I were to sell a position based on it being up or down, that's not going to get long-term success in the long run. Those of you know that I've sold two stocks since starting this channel. I've sold Foot Locker, which was one of my best performing stocks. I sold for nearly a 50% gain, and then I bought that for under $20 a share. And then I know with Wells Fargo, I sold for a loss. I sold Wells Fargo for about a 10-15% loss. I didn't like where their business was going. I didn't like their outlook. And let's go ahead and look at IBM and AT&T. Let's see how their stock price has performed through this recession. So when we pull up IBM here and we look at their year chart, they are doing okay. They bounce back a little bit, not nearly as high as what like the S&P has done. They do still have that massive yield, so I'm not going to get rid of them completely. I do think on the long term they'll probably be able to keep that dividend yield. It's definitely at a high risk. And speaking of high risk dividend yields, let's go ahead and look at AT&T. Pretty much a similar story. They bounced back a little bit, but not anywhere near the all-time highs. So share price is not a factor here. I'm not selling them because they've underperformed. I'm not selling them because they're skyrocketing. They're obviously very lagging in the market, but that has little to nothing to do with the stock price and what my decision is for buying them. The reason why I'm adding WP Carey and Store Capital is because of their long-term benefits for the stock. And I'll go over that in just a minute. But let's start going over some of the problems with IBM and AT&T. Now, one of the reasons why I wanted to add these two stocks is because they're both dividend aristocrats. They have long-term dividend growth, regardless of how fast it is. It's pretty slow because they're very old companies, but they have a very, very long-term dividend growth story. Now, the thing is, IBM to cut thousands of jobs as coronavirus plays out. CEO has promised a 5% dividend will remain intact. This is what I don't like to see. Just to keep the dividend intact, to keep investors happy, they're having to fire thousands of workers. Now, I understand that keeping a dividend for keep investors happy, investors bring in money to the business, so it is a bit necessary, but I do hate to see that thousands of people are getting laid off. And just overall in general with IBM, with where they're going as a company, they have a recent CEO change. They did just purchase Red Hat, so they took on a lot of debt, and they're looking at maybe purchasing even more smaller companies, but I think right now they're just in such of a transition phase. I think it's going to be a lot longer for them to get out of this recession than I thought it would be. I don't think they're going to get back to their growth stage probably for a long time, probably for several years. And in the meantime, if that doesn't work out, that IBM is going to zero, more than likely, or it's going to get cut dramatically. So I am going to lower my position in IBM. I'm not chasing yield, I'm chasing dividend growth. I do like IBM as a company, so I'm not going to get rid of them completely, but I'm going to lower them down to 1% in my portfolio, down from 4%. And the same thing with AT&T. So for me, this is kind of just the final straw. I've been overlooking things with AT&T. So many people in the stock market that are dividend investors. When it comes to dividend stocks, I feel like AT&T is like the holy grail. Everybody looks up to AT&T like, oh my gosh, they pay such a high yield. They're so defensive in times like now during recessions where everybody needs their cell phones. They'll be able to maintain that dividend for years like they have been, even with all that debt. And for me, I kind of overlooked all the management issues, like buying cable companies like DirecTV when industry is dying. But also, this is just kind of the final straw for me, the HBO Max. So they've made some issues with HBO in recent years, and this streaming service launch was not available to Roku. Roku is a huge force in streaming and a hurdle for HBO Max. Roku controls nearly 45% of top box viewing time. So 45% of time viewed on streaming is through Roku, and HBO Max doesn't even have the option to be viewed for them. Nearly half of the market, they're not even able to capture. I believe they're not even available through Amazon either. But the point is, a company this large with billions of dollars worth of assets and resources and tons of workers that they're available to help them, they should be able to perform a launch of a service, of their own service, a lot better than this. And for me, it's just kind of the final straw. I'm going to keep them at 1% just because they do have that massive dividend and long-term growth, pretty much the same thing as IBM. But for me, just with management, there's just better companies I can put my money out there. They've barely held up in stock price throughout this recession, and their dividend growth for both of these companies have been minuscule in the last year. So overall, I'm going to lower these to 1% in my portfolio. You can see them at 1% here down at the bottom. And then, so to get into the companies that I'm going to be adding, Store Capital at 3%. We're up 6% on it. And then we added WP Carey. We're up 6.5% on at 4%. So 7% extra towards real estate. These are both REITs or real estate investment trusts. So I now own 3 REITs, which is Realty Income, WP Carey, and Store Capital. So let's go ahead and pull up their investor relations page. Okay, so to get started here, we have Realty Income's page, the one I've showed before, and I went over a lot of the details, and I won't go through all of them, but basically we went through a lot of different things in previous videos talking about the extremely high occupancy rates, the great dividend growth, the awesome management behind this company, and some of the long-term potentials for owning this amazing, incredible real estate company. But not to get too deep into the details here, but just to give a quick flash into some of the statistics behind this company. So last it was reported they had a 98.5% of all properties are occupied, being paid. They have a little over 6,500 properties last reported, and only 97 of those are vacant. And then if you see their top 20 tenants here, the one thing about Realty Income is that their top 20 tenants are heavily invested in towards retail, and they are a retail REIT, but they are extremely diversified between hundreds of different businesses. So it is very diversified and a very well-run company. So let's dive into WP Carey and Store Capital. So with WP Carey, we're going to go to Investor Relations page here. We're going to go to the Investor section. And as you can see here, if I scroll down through the Investor Relations page, they just raised their dividend, just like Realty Income did this month. Realty Income raises theirs at least every quarter. Sometimes they even do it more than that, but they just raised it from $0.233 to $0.2335. So a very small raise there. And the same thing with WP Carey. They raise it every single quarter. It's usually very small, but they raise it every single quarter consistently. So it was from $1.04 to $1.04.2. And you see here, this is the one section that I mainly want to focus on. So I went through both of these companies with Store Capital and WP Carey, just like I did with Realty Income when I was first looking at buying these stocks. And I went through a bunch of their reports, like their annual reports, and I really dove into their properties. But if you look here at the snapshot of a lot of their main statistics that you need to focus on, this will give you a good idea about what these companies are and what they're focused on doing. So first of all, they have $1.1 billion in annualized base rent. Their weighted average lease term is 10.7 years. Occupancy is a little bit higher than that of Realty Income at 98.8%, 1,215 net lease properties, and 352 tenants, and 141 million square feet. So the main two things that I wanted to focus on here is these two. Weighted average lease term, 10.7 years, and the occupancy rate is nearly 99%. That is what I want to see right there, that nearly every single property they have, so out of the 1,215 properties, I'm sure 1,100 and change are occupied. Of those 1,100 and something properties that are occupied, their average term is nearly 11 years, over a decade. So basically half of my lifespan. I'm 21 years old, so basically these terms are half of my lifetime. That is so crazy to think. And of these 1,200 properties that people have, they're diversified between 352 different tenants. So they're diversified, they're well occupied, their lease term is extremely long, and then one more thing that I wanted to point out here is that this word right here, net lease properties. This is not like your typical real estate investment trust. One of the things that appeals to me so great about Realty Income is that they are a net lease property company. With WP Carey and Store Capital, that is one thing that all three of these have in common, and that's one of the reasons why I wanted to invest in them. So a lot of real estate companies are liable for a lot of things that go on with the property, but basically with a net lease property, they do nothing but other than really just supply the building and the land. So with a net lease property, the person buying the property or renting out the property, they're responsible for the property taxes. They're responsible for all the juicy, ugly stuff that comes along with owning real estate. And basically, like I said, to repeat myself again, these real estate investment trusts that are net lease properties do nothing but pretty much provide the building. So just Googling net lease on Google, this is just to give you a good idea about what these net leases are and how they work. A net lease is a real estate lease in which a tenant pays one or more additional expenses. They generally include property taxes, property insurance premiums, or maintenance costs, and are often used in commercial real estate. There are three basic types of net leases: single, double, and triple net leases. All these are focused on triple net leases, but regardless of the double, single, or triple net leases, they are all focused on making the buyer pay a lot of these extra expenses that these guys don't want to worry about. So they're not focused on paying, like I said, the insurance premiums or the property taxes or the maintenance costs, whatever. So regardless of whether they're out of the liability for one, two, or three of these, regardless, it is just less that they have to worry about, less that they have to have people to maintain them, and less money that they have to spend. So that is some great information to learn about all these three companies, which makes them even more bullish for the long term. So when we go ahead and click their portfolio tab here, right below that snapshot, 99% of our leases have contractual rent increases and 62% are tied up to CPI, position us well for a high inflationary environment. You can see here there's a pie chart here with uncapped CPI at 38%, CPI based 23%, fixed 32%, other 4.6%, and then none 0.8%. So you can see here they have 63% of their properties in the United States, 34% in Europe, and 2% in other countries. Now that's one cool thing that I think it's a little bit interesting. Those of you that know me, I don't invest in foreign investments. I'm not interested in foreign companies, but United States is primarily their focus, but this is exactly what I want. They have United States company, but they're also diversified a little bit in foreign countries like Europe and other countries. So that is awesome. So that way, if there's ever a huge downturn in just the United States, we are diversified a little bit in Europe, but I want the main focus to be the US, which is exactly what I want. If we click property type diversification, this is what's really interesting here. If we click property type diversification, 23% industrial, 21% in warehouse, 22% in office, 17% in retail, self-storage net lease is 5%, and then 9% in other. You can see they are in multiple industries. I would say that is the one very small negative about Realty Income, because they are such an amazing company, is that they are so focused into retail. Majority of their entire portfolio is just retail. If you see here, we go to the pie chart for Realty Income. 83% of their portfolio is retail. They have 11.5% industrial, 3.7% in office, and then 1.8% in agriculture. So basically, they're nothing but a retail REIT. This little extra, that's so small. What is that? 17% in total between all of these. That is so small that they're basically nothing but a retail REIT. Now that's fine. There's so many different areas of retail that they can be in, that they can thrive in, so that's okay. But it's still nice to see that they're so diversified with WP Carey: industrial, warehouse, office, retail, self-storage, other. They're in 1, 2, 3, 4, 5, 6 different areas, and their heaviest section of industrial makes up less than 1/4 of their total portfolio. So not only do they have long-term leases, they're completely occupied, they're not obligated for all the net leases liabilities that a lot of other retail investors have to deal with, and they're diversified between so many different sectors. And then we're going to click the last tab here, and then we'll get to STORE Capital: tenant industry diversification. Retail, consumer services, automotive, business services, cargo transportation, grocery, healthcare and pharmaceuticals, hotel, gaming and leisure, construction and building, capital equipment, sovereign and public finance, beverage, food and tobacco, containers, packaging and glass, durable consumer goods, high-tech industries, insurance, banking, telecommunications, aerospace and defense, non-durable consumer goods, media, advertising, printing and publishing, media, broadcasting and subscription, wholesale, chemicals, plastics and rubber, and other. You can see the mass amount of tenant industry diversification. I won't break these down one by one, but basically they're in so many different areas that you can't even really put a pin on it. So that's what I like to see, is that, for example, if something were to happen to specifically retail, or retail was to go down the toilet and then industries would be thriving, this would not really matter so much for WP Carey as it would for Realty Income. They're diversified in so many different areas that they're not as big of a risk as Realty Income or a lot of other real estate investment trusts. If we go to the top 20 tenants here on Realty Income, you can see their number one tenant is Walgreens, which makes up 6% of their revenue. So if Walgreens was to go bankrupt, 6% of the revenue would be gone. Now that's not a huge liability, but it's something to think about. So 6%, but with WP Carey, U-Haul International is only 3.5% of their total base rent. So half of that almost of realty income. You can see that their net lease term for a lot of their main contracts here, you said that their average was about 10.7. I think that's what it was up here. Is that what it was? 10.7? Yeah. So 10.7 on the average term. A lot of their top tenants are much higher than that. Hellwig, 16.9 years, 14.7 years, 10.2, 24.1 years, 23 years. Extra Space Storage was a stock that I talked about maybe even investing in. I love storage properties. 24, 23 years. A lot of their average leases are older than me. 23 years. You can see that it's just crazy that they have agreements that are 2, 3 decades out, and that's longer than I've been alive. So if that doesn't prove it to you, I don't know what will. So let's go ahead and just get into some of the basic information. Give a snapshot for Store Capital. Basically, with these investments, I don't want to spend too much longer on this video. I'm going to wrap it up and just give you a snapshot of what Store Capital looks like. And just to give you an idea that these net lease real estate investment trusts, if ran correctly, can be very profitable investments. And the thing is about these REITs, because they're forced to pay dividends by the government, you know they're going to keep a high dividend yield regardless of whether they're forced to cut in a recession. And their share price gains over time as well. So real estate is really a sector that I've been looking to invest more in, and I've just been trying to decide what I wanted to mess with during this recession. But overall, let's go ahead and give some of the information about Store Capital. So those of you that don't know, STORE is single tenant operational real estate. It's what STORE stands for. And you can see here their occupancy rate is 99.5%, the best of the three. They have 491 different customers, and they're in 49 of the 50 U.S. states. They have 2,552 investment property locations, and they estimate that they are to exceed $3.4 trillion in market value and to exceed more than 2 million properties. So you can see that the management is focused on the long-term growth here. They're focused on acquiring more and more and more properties. The one thing that's really cool about real estate is that it's really similar to the stock market in the sense that no matter what, in the long term, it's only going to go up. The population's going to grow. Real estate is going to get more and more in demand. It doesn't matter if you're talking about agriculture land. It doesn't matter if you're talking about office space, talking about just the basic home for the family to live in. Real estate is going to get more and more and more in demand, and that's at least until Elon Musk takes us to Mars. But in the meantime, real estate is pretty much going to do nothing but go up. It really has no downside to it. So real estate, if you were to invest in anything outside of the stock market, if you were to say, Jordan, what's the best investment outside of the stock market? I would say real estate. A lot of people who are not interested or don't have the capital to invest directly into buying their own rental property, they mess with REITs. Because with this, what is their stock price? I believe they said it was 25. So yeah, about $26. So to get an investment property, to get a rental, you might have to put up $10, $20, $30,000 minimum. That's the minimum just to get started, to put down the down payment to get a rental property. And even then, you're messed with property taxes. You have to mess with maintenance repairs. You have to deal with tenants. You have to occupy those properties. Then that's one of the main things there. You might not even get anybody to occupy them. And there is a huge risk because when nobody's occupied in there, it's just sitting. It's just collecting dust. You're taking on that huge risk. But investing in REITs, you take $26 and you own 2,552 properties with a mere $26. That's all you need up front. And even with today, with fractional shares, because M1 Finance, you need a minimum of $1 to own 2,500 properties. Is that not incredible? So with $3, you could own 2,500 through Store Capital, you can own 1,200 through WP Carey, and you can own, what was it, like 6,500 properties. So with $3, you can own about 10,000 properties diversified all over the globe. So just think about that and think about the advantages you have today as an investor today versus someone in the past. So overall, guys, that's my opinion on all three of these. I think long term, I am very bullish on all three of these companies, and I think they're going to do just great. I'm very happy with what I bought them at. If you wanted to see the year chart on them here, I'll just pull them up just so you can get an idea of what they look at. I bought Store Capital. You can see it's about $26 now. I picked these up at about $24.42 a share. And then if we go here to WP Carey, if I search that real quick, it is currently sitting at about $75 a share. And with WP Carey, what I purchased that at, I purchased it at an average share price of $70.79 a share. So both of these, I think it's about a 5.8 yield. Overall, guys, I'm really happy with my decision. I did sell my position in International Business Machines and AT&T already, and I already added Store Capital and WP Carey. So thank you guys so much for watching all the way to the end. As usual, like I forgot to mention at the beginning of my video, if you're interested in getting started with M1 Finance, if you want to use my referral link to get started, you can get $10 for using this link right here. It'll give you $10 for getting started with your M1 Finance dividend portfolio, and you would help me out a ton through the channel. So leave me a comment down below in the comment section what you thought about this video. Do you think all three of these real estate companies are good investments? Do you think that selling out of IBM and AT&T is a bad decision? So go ahead and let me know down in the comment section. Thank you guys so much for watching, and I'll catch you next time.